Moving on to the Iron Condor. Our Iron Condor is a defined risk strategy around the strangle. As I mentioned before, the strangle gives you a little bit more wiggle room, as does the Condor. But having said that, our Iron Condor is not going to give us as much premium. The Iron Condor is a market neutral strategy, and unlike the Iron Butterfly, this one gives us a little bit more wiggle room. As you can tell by the flat top on this, it doesn't come to a point. We have a range where we can receive our max profit. You know, we did gain a lot more in premium from the Iron Butterfly, but we have more risk there. So if you have a stock that's really trading sideways in a very tight range, then the Iron Butterfly would be one to have on. Because I picked eBay, I would probably pick the Iron Condor over the Iron Butterfly, simply because it's been trading in a range, but it's been about a $5 wide range. So as you can tell, even if we go past the standard deviation by a little bit, like if it broke out or below my support and resistance levels on eBay, I would still be making a little bit of money on that. So as you can tell, our max profit for this is going to be $1.09 or $109. The nice thing about this, and I forgot to mention this on a couple of the other ones, is your buying power effect with the defined strategy is a lot less than if you are naked. Buying power effect on the other ones are in the thousands, a little over $1,000, whereas these, you know, we're losing $250 in buying power effect. And as you can tell, where our max loss is, it's just above $150 for this strategy. So we are looking to be able to make $109 and lose right around $150 with our commissions. So that would be our max loss. Pretty good risk reward, and the volatility, as you can see, is very low. So we are in a low volatility environment, so that would be a good time to implement something like this. The trader of an Iron Condor would like the underlying to trade between the short call and the short put strike price at expiration and have the options expire worthless. Similar to the strangle, but like I said, we have limited risk with this strategy. And to create an Iron Condor, we're going to sell the out of the money strangle and buy the wings. The base is the strangle, the wings are our defined risk. Or, in other words, a further out of the money call or out of the money put, which, like I said, limits the risks of the call and the put that we are naked. Implemented in low volatility environments, again with the expectation of continued low volatility. It's in order to take advantage of the theta or the time decay. Same as the rest of them, this one just has a little bit more wiggle room and defined risk. The max profit is achieved when the underlying is trading at a price that is between the short call and the short put and will expire worthless. Again, there's going to be two max losses on this type of strategy. The max loss is limited but is higher than the max profit, generally speaking. Like I said with this one earlier, our credit received was $1.09, but we are looking to possibly lose $150. The max loss is the long call minus the short call minus the net premium received, and the max loss for the put side is going to be the short put minus the long put minus the net premium received. The break even, again there's two. The break even for the call is the short call plus the net premium received, or for the put it's the short put minus the net premium received. So back to our example of the Iron Condor, or our graph of the Iron Condor. As you can see at the bottom there, I have a list of what we did. We sold the strangle, which is selling the July 15 calls at a strike price of $62.50, and I also sold the July 15 puts at a strike price of $57.50, which is at the top. You can see at the top where those 2 points are short strikes. At the bottom, where we define the risk, where we are in negative territory but doesn't allow us to go any further negative, is where we bought the July 15 calls at a strike price of 65. We did the July 15 puts at a strike price of 55. So like I said, our max loss is going to be the long call minus the short call, which is $2.50, minus the credit received of $1.09. Let's just say $1 to make math easy. So we can lose $1.50. The max loss on the put side is going to be our put that we sold, which is $57.50, and the put that we bought, which is $55, equaling out to $2.50 minus the credit received, which is $1.50 for all intended purposes. The break even for the short call, we got the short call on at $62.50, and we add $1.09 to that, which brings our break even to just over $63.50, which is where you can see that line crossing the dotted line. On the put side, we sold the $57.50, so we subtract the credit received from that to bring our break even down to $56.50, which is where you can see the line crossing the dotted line there again.
Alright, sorry I missed you guys yesterday, but you know what I gotta say, if you can't take that, take it easy.